Good afternoon from here, and welcome to yet another training video. Just a quick reminder of what we did the last time. We established a peculiar concept, which we talked about market, that's candlestick pattern. And graciously, I think we have successfully wrapped up on that concept. And like I made mention on our previous section, that the next section we'll be looking at a very, very different concept, which is called the market structure. The market structure. Right. So the market structure, I would want you to do just two very basic important things as we dive into this particular concept, the market structure. One is pay close attention to the parts. Pay close attention to the parts. Two, always go back to chart. I always say this, and I want to keep saying it until you start doing it, because I feel like you're not doing it yet. And if you're doing it, I think you're not doing it enough. All right, so the market structure, all right, is one of the most important skill that you need as a trader. The market structure is one of the most important skill you need. It's the ability for you to read the market structure. All right, it is critical skill that will allow you to use the right price action strategies in the right market condition. Now, it is in other words to say, you're doing the right thing at the wrong time. If you don't have a concrete, solid knowledge of what the market structure is about, you will end up doing analysis the wrong way, even if or irrespective the fact that you might be doing all of the proper analysis. It's just in a simple scenario where you wear your footwears opposite in the opposite direction, in the opposite way, all right? Or you're eating with the opposite hand, right? So it's actually the major important thing is you're eating, but the next thing you want to also know is if you're doing it correctly. All right, so having a very solid foundation on the market structure helps you or solidifies your analysis accuracy. All right, so you don't end up working on a very productive path and ending up getting an opposite result. That is the essence of doing this, and then that is the essence why you should master the market structure and understand and assimilate it properly. All right. So on this particular section, you're not going to trade all the markets the same way. You need to study how the market moves. All right. So movement is very important. In fact, movement is the basic thing we do in the financial markets. Whatever market it is, bond, crypto, oil, stock, index, we would trade majorly movements in the market. So either the market is moving upward or is moving downwards. So whichever case it is, you should understand what it's doing at a particular time that you're analyzing it and know the right proportional to engage. Okay, I believe that is well understood. So you need to study how the market moves and how traders behave in the market. The market structure is the study of what? Of market behavior. The market structure is simply the study of market behavior. We're doing a simple introduction a brief introduction of what we're going to be doing for the next 2 to 3, 4 days on the market structure. Okay, so having said that, if you can master this skill, if you can really master this skill, when you open your charts, look at what happens. Buyers or sellers. All right. So when you know very correctly that in the financial market we do 2 basic things, either we're selling or we're buying, and those requires movement from point A to point B. Gives you a very broad knowledge of what a market structure is. So and if you can master the skill, when you open your chart, you will be able to answer these important questions. If you can master the skill, this is the ability you will be able to wield. You will be able to gain, to acquire. Right? 1, what the crowds are doing. What the crowds are doing. You will eventually know what the crowds are doing, which will automatically lead you to trend. Right? So firstly, you will know what the crowds are doing. You would also know who is in control of the market, buyers or sellers. The market structure, the adequate knowledge of the market structure will reveal to you instantly what the crowd are doing, and then you will also end up knowing who is in control, who is dominating. Is it the buyers or the sellers? Not just that, you will also be equipped with the knowledge of what the right time to place to enter or exit. Now, the market structure will equip you with what? With the knowledge of when to enter the market and when to exit. It will also let you understand when you just have to stay away. All right. So there is a saying, a trade not taken, all right, is better than a trade lost. Okay, so okay, there's another way also. We call it a profit not made is better than a profit lost. Right, because here you secured your account other than dropping it, other than losing it. So the market structure also revealed to you when you got to stay away and when you have to participate in the market, right? So through your price action analysis, you will experience 3 types of markets, all right? So from our training on this market structure, you would be equipped with powerful knowledge of what the 3 types of market. That is, we're talking about the trending market, the ranging market, and choppy market. All right. So in this particular section, we will be doing all of those. But I would start the market structure with a very form of its kind, which is called the trending market. I'm putting it on the screen. You should put this particular concept down on your jotter or your note or your whatever you use to take note. The trending market. All right. The trending market. This is one of the most. This is a part of the market structure. All right. So remember I outlisted there are 3 types of market structure. We have the trending market, the choppy market, and then the ranging market. So we're looking at the very first, the trending market. The trending market, you should write. Trading markets are simply characterized by a repeating pattern of higher highs and higher lows. All right. So in a trending market, we have a formula or a pattern in this form: higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs, higher lows. All right. So this is a repetitive pattern in the financial market. In the trading market, you would mostly see, or you will see a pattern in this form: higher highs, higher lows, higher highs, higher lows. And you would also see patterns in this form: lower low, lower high, lower low, lower high, lower low, lower high. These are the two patterns that exist in a trending market. All right. If the market is not making a higher high and a higher low, then it's making what? A higher low, a lower low, and a lower high. Excuse me. All right. So I'm going to display exactly what we mean by a lower low, lower high market scenario. Okay. So beg your pardon. Give me a few minutes. Okay. So this is literally. All right. Okay, so this is literally what it's gonna look like for an uptrend. Remember, we're looking at a trend. All right. So when we have a situation in the market where there is a lower low and a higher low and a higher high, higher low, higher high. So the HH represents higher highs, and the HL higher low, higher high, higher low. It simply tells you this is what a trending market. Then you go further towards defining what trend it is. Of course, you know that it is what? An uptrend. You don't need a seer to tell you that because price is what is going higher, just above, making a higher low patterns and formations. You just know that price is on an uptrend. So higher highs and higher lows are the hallmark of an uptrend. They are the hallmark of what? Of an uptrend. So in a market that is making a lower low, lower high, lower low, lower high, it simply tells us that this is what? A downtrend. But then I want you to know the keyword in what we're discussing today that is relating or falling back the trend. All right. So we are talking about market structure. Then we have listed the three basic market structure that exist in the financial market. We know about the trending market. We'll establish a background on the ranging and of course on the choppy. But let's focus our attention more on what? The trending market. So I've given you a pattern of how each of these trending market looks like, from the uptrend to the downtrend. They make ranges or they make patterns in form of higher highs and higher lows for an uptrend, and lower low and lower high for a downtrend. Okay. So as you can see on this picture I displayed here, they quickly or obviously explains all of these. So you don't need indicators to tell you if it is bullish or bearish. Now, remember that a bullish market is simply a market that is what? Making a higher movement, that is going up or rising. All right, from each candle for pattern formations or its candles. Remember when we talked about candlestick and then we elaborated the different candlestick we have in the market. We have the bearish and the bullish, and then I mentioned that the bullish is simply a market that is what? Making highs, that is going up. And then the bearish is simply a market that is going, a candle that is coming down. So when we refer a bullish trend or a bearish trend, it is still proportional to what we talked about on the candlestick, individual candlestick patterns. A bullish candle, a bullish trend is simply a market condition that is what? Going up. A bullish trend, all right? So a bearish trend is just the opposite. So if it's going up on the bullish trend, that is on the bearish, is obviously dropping or coming down. Hope that is understood. Now, trending markets are easy to identify. Like I mentioned, you don't even need a seer or a prophet to tell you that this market is on an uptrend move. This market, this is Euro JPY, and I think we traded this currency today. It's Euro JPY, and you don't need anybody to tell you that, hey, this is making a higher high and higher low movement, a higher high and higher low. So even at the point where you feel like you're confused, you can use some tools to confirm that the price is going up. All right, I use some tools. Or basically, there are indicators that can even help you do that. Like I have the moving average on my chart. You can see that the moving average is just going up. There is no two ways about it. If it's not going up, it's going down or going sideways. So we obviously know that everything about this market is just on the up end. So it's really, really easy to identify. If it is doing a series of higher high, it is simply an uptrend. I've talked about that. According to statistics, trends are estimated to occur 30% of the time. So what happens on the rest of the 70, market consolidates or choppy or goes into an extinction state. So to determine whether a market is trending or not, you have to use bigger time frame, such as what? The hourly, the daily, for the 5 minutes, but preferably hourly chart, hourly time frame. Okay, so we're making progress, aren't we? Of course we are. Now, how to trade trending market? That should be a subtopic you should take careful note of. How to trade trending market. How to trade trending markets. How to trade trending markets. Okay, so one thing is to know, one thing is to have a knowledge of something, and another thing is to what? To practically apply the knowledge. If we just know how to identify a trending market, without a solid knowledge of how to trade it, we won't get the result we desire. So how to trade is a different, bigger game than just how to identify it. So if you can identify a trending market, it will be easy for you to trade. All right. If it is a bullish market, you will look for what? A buying opportunity. Simple. If it's a bearish market, you look for what? A selling opportunity. You should always know that the trend is your friend. You should always know that the trend is your friend. If it is a bullish market, you buy. Bearish, you sell. Bullish, you buy low. Okay. And bearish, you sell high. Trending markets are characterized by two important moves. The first move is called the implosive move. I'll put it on the chart. The first move, how come I lost my train? Excuse me. Okay. The first move is on the chart. The implosive move. I will talk about the implosive move much intensively on another concept. That is what we'll talk about. We'll be introducing the demand and supply. You will learn more of the implosive move and the retracement move, but we'll talk about the implosive move. So the trending markets are characterized by two movements. We have the first movement, which is called the implosive, and then the second movement, which is called the retracement. All right. So the implosive and the retracement movement. Retracement. All right. So which is the implosive and which is the retracement? The implosive is this bigger push all the way up. And what you should know about implosive movement is there are multiple ERC candles, larger candles, that is candles with longer body. You tend to find longer candles in an implosive movement. In this form, you can see that it's an implosive movement. All right. So ERC candles are easily located for an implosive movement. And another thing you should know about an implosive movement is price move faster for in an implosive movement. And the opposite for a retracement movement. This is a retracement movement. This candle, the white candle on my chart, my cursor is right here. So the white candle, these two white candles are the retracement movement. All right, and the retracement movement is characterized with smaller body candle. You can find more of hammer pin bars in retracement movement. You can find some of those little candles, the doji, all right, the hammer pin bars. You can find them more in the retracement movement. Another characteristics of a retracement movement is price makes more of slow push. Price moves slower, all right, in the retracement movement, while on the implosive movement, price moves faster, and there are more of ERC candles in the implosive movement than compared to the retracement movement. And one thing you want to know is you want to buy at the retracement, at the end of a retracement, to position well for an implosive. All right, you want to enter at the at the retracement, at the end of a retracement, to position well for an implosive. Now, this both market movement happens on both an uptrend and a downtrend counterpart. So if it's on an uptrend, just like in this case, you want to position right at this close of this retracement, and up price goes. All right. If it's on a downtrend, okay, let's see if we can see a downtrend close by. Okay. All right. All right. So we've been having a total massive uptrend all the way from there. But let's just use this for instance. But this is really not the kind of uptrend we are looking for all the way. But all the same, I believe you are getting the scenario, but it can still be very important. I mentioned this. Whatever we talk about on an uptrend is directly proportional to the downtrend. It's just vice versa, right? Just vice versa. It's just the opposite. So if we have an implosive movement on an uptrend, which makes price move faster towards the upper momentum, that is, if it is an implosive movement on a downtrend, that means price moves faster, lower than it does on the retracement movement. So moving forward, I am going to display another chart, all right, from the implosive and retracement. So here we have it. So the uptrend, implosive moves, and retracement. Now here is the implosive. You see that around the implosive area, we have more of ERC candles and price move more faster. All right. So from just this retracement to the next implosive, to the next retracement, I beg your pardon, we had almost close to 10 movements, 10 candle movements, depending on the time frame we are on. So here we have 1, 2, 3, 4, 5, 6, 7, 8. All right. So we have 8 movements upward around the implosive moves. But then around the retracement, we just had 1. Okay. So you position your entry at the end of a retracement, so you can catch more pips, more money in the implacement move. All right, I believe we're making progress. So as you can see from this chart I displayed, the market is making a higher highs and higher lows, which indicates a bullish market. If you see this market, you would think of buying, all right? But as you can see, the market is making 2 different movements. The first move is a implosive. And the second one is what? A pullback or retracement. Professional traders like you, of course, you're already a professional trader. For the very first time that you decided to be part of this environment, you became a professional. So professional traders like you understand how trending markets move. They always buy at the beginning of an implosive move, or they buy at the end. So when we say we buy at the beginning of an implosive, that is, you buy at the end of what? A retracement, the position for an implosive move. If you're aware of how trading markets move, you will know that the best place to buy is at the beginning of an implosive movement, or at the end of a retracement movement. Who buy an uptrend market at the beginning of a retracement move? Novice. They got caught by professional traders and they don't understand why the market hit their stop loss or why the market strikes them out of profit. It is very important. So let's see the let's take a quick example or a quick instances on the downtrend. So for a downtrend, we have the same rule applicable. So here, price dropping for the implosive movement. So like I mentioned, wherever there is an implosive movement, you expect to see what? Multiple ERC candles, right? But in a retracement movement, you tend to see weaker candles like a doji, a hammer, a shooting star. Those are characterized by a retracement movement. It's very important, you know. I mentioned from the last, that is when I was talking about the implosive and the retracement from an uptrend and a downtrend. I mentioned some of the few characteristics of an implosive and of a retracement. So those are still valid for a downtrend. I'm just displaying this chart so you can also see visually what price is doing. What we do here on each section is not enough. I always say it. It's not enough to give you the confidence you need. Experience, they say, is the best teacher. So you have to always go back to your chart. Look at these things carefully. Build an acquaintance and now align your emotions with the market. All right? Fall in love with it. That is how mastery comes. Let's proceed. Okay, so in our next concept, in our next section, we will introduce support and resistance. Support and resistance. Right, that will be on our next concept. Always remember to always go back to time. That'll be all for now. See you all on our next trading video. Bye for now.